Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. Obviously, I'm going to interject my financial opinions as we go through it. We're going to be talking about commodities, the stock market, financial markets, and wealth building. That's the main areas that I focus on and like to talk about. Again, if you want to follow me, it's at finding_finance. And if you guys want to know how I'm playing this commodity bull market that's coming up, check out finding-value.com. That's where I talk about individual companies, what I'm playing. We've got a lot of really leveraged plays, lots of upside, very good rewards with, I think, decent risk. So good risk reward bets across the board. And I'll talk about a lot of this stuff on Sunday, 5 p.m. We have a question and answer session there. You can ask questions directly to me over a Zoom call if you guys are interested and need any help with anything. All right, let's dive in and see what people are talking about. So we've got NVIDIA here. I like to look at the opposite end of the spectrum sometimes, the tech stocks, see what they're doing. Tech stocks, they could go up. I'm not saying that they can't. But what I am saying is this doesn't look very good for NVIDIA. Could this be a diamond top? I don't know. We'll see. What I generally like to do is I like to buy when things are breaking downtrend lines that are very low. I don't go after stuff that's had a run from $140 up to $480 and then be like, well, maybe I should chase this performance. It's going to continue. That's not what you want to do, in my opinion. What you want to do is you want to find stuff that is coming out of basing patterns. That is exactly what you want to be looking at. And right now, commodities are coming out of basing patterns, and a lot of the other sectors have run quite a bit. Some of them could be topping against other asset classes, and we want to be in the outperformer of the asset class. And NVIDIA, in my opinion, I think it's going to have a rough road ahead of it. Maybe not. I mean, I will say this, that these tech stocks do have a chance when interest rates go down. If they come down in the short term, they could do well. They could do very well. But I do think that rates will get a pullback for, I don't know, however many weeks or months, maybe even a year, and then it'll reverse and go back up. That's my guess for rates. And rates are a headwind against a lot of these growth stocks. J.R. Walensky says, bought a final tranche of deep yellow. I'm fully locked and loaded. That's great. Great. What I want to talk about this chart here. Let me open it up real quick. We are starting to kind of come up to these areas where we've got resistance that we're about to break to the upside of that resistance. What that means is we're going to probably run. And I'm not just seeing that in deep yellow. I'm also seeing it in Cameco, and I'll show you a picture of Cameco as well. I put a fractal up. This could be the beginning of the very, very big move. Yes, we already had a decent leg up. Yes, we bought a lot of the move before it on the channel. We bought a crap ton of uranium, and I know it's speculative, but this is probably the only sector where I've got the highest conviction for speculative stocks. And again, guys, I'm not a big fan of speculative stocks, but I have to go in it just because I know what the rewards potentially could be. We're breaking these resistance lines at the top here, about to put in 52-week highs in some of these stocks. I understand, and a lot of people ask the question, what about these explorers that haven't moved? They don't want to hold on to the explorers. They want to move their money up the food chain into these guys that are breaking to the upside. All I'm going to say is I think the explorers are lagging behind. I think that they are a good opportunity for someone who's patient. Because when the explorers, looking at last bull market, they lagged behind Cameco, they lagged behind some of the developers, which this is a developer, and then they just did a moonshot. And they did it very quick. So the way that I view that is Accumulate when no one's looking and when people are disinterested in it. That is how you make money. Accumulate when people are disinterested. And if the sector is all starting to break out to the upside like we're seeing in Deep Yellow here and in Cameco and other companies, that would push me even more into the explorers that haven't moved yet. And that's where the opportunities are, but you're going to have to be patient for the move. And then what I expect to occur is that at some point when the retail sector comes full-fledged at this, they're going to go after the small speculative exploration companies, and we're going to see a monster move in some of the small exploration companies. So that's my expectations. Here's Jamie Carusco. This has got to be one of the scariest charts I've come across, as it fully depicts the credit fiscal mess we are in. But it's also the best rationale for owning gold and the precious metal sector as we head into this economic storm. And what this is your interest payment relative to gross domestic product. Your interest payment obviously doesn't do anything. It's just payment for interest. And that is compared to our earnings capability, which is gross domestic product. And you can see that we are at a very high level. And it is getting worrisome because if this continues to go up, we will be spending more and more money in interest payments. More and more of our productive capacity is going towards something that is just to cover interest. And that is scary. Now, here's the Kobayashi letter. I'm using some of these not because I believe in what they say, because I'm exactly opposite of what they actually say. And I want people to understand the paradigm and the viewpoint that I look at some of this stuff. So this guy says, commercial real estate lending has declined to historically low levels. The change in commercial real estate debt outstanding was 1% in quarter 2, 2023. That was the lowest quarterly reading since the first quarter of 2014. On top of this, only 28.2 billion of loans converted. So when you look at this commercial real estate debt outstanding change from quarter earlier, and you look at the percent down here, you've got maybe 2014, and then you can see it goes on up and it cycles back and forth. Right where we're at, which is that black dotted line, it's the lowest in nearly a decade. Now, some people, what they do is they'll look at that and they'll say, oh my gosh, it's the lowest it's ever been. As an investor, you know what I do? I say, wait, this could be a really good opportunity. It's the lowest it's been in a decade. So when I look at things and I look for potential investments, I look at things that are down. I look at things that people say, oh man, that is so rough. I can't believe how many losses are over there. That's exactly when you want to get interested in it. So I'm not saying that commercial real estate, and I don't know much about commercial real estate, but conversely though, when people start to post things about being this low, this is generally when I start getting very interested in a sector. This is uranium. This is something I posted. Cameco has a blue fractal overlaid over it from last bull market. It is following it very well at the moment. So I took this fractal here. You can see the Livermore accumulation cylinder in the beginning here. I copied this, created that blue line, and overlaid it on what I think could potentially be the move in Cameco. It's off the chart, the blue line, when I stretch the fractal out. This here is your Livermore accumulation cylinder that we just went through. That is generally where the really smart investors accumulate. The institutional guys come second, and that's kind of where we're at, is the institutional investors. Retail's not here yet, and then the retail guys all jump in after we get good momentum more up here. So Cameco is actually following, if you were to zoom in, I can't zoom in on this, but it's following the exact move of the fractal, which is crazy, which means we have a long way to go. lots more upside, which even makes the case that some of these explorers could be incredibly good opportunities. And I post what my favorite explorers are on the website, so everyone can see at least my favorite and what I'm buying. Nice move underway for NXE. So we've looked at Cameco following that fractal, very similar to last bull market. We looked at deep yellow that was breaking its highs. And what are we doing here, guys? We're going to break into 52-week highs on next gen energy. We are going to break away from that resistance, and in my opinion, we could run big to the upside. So that's kind of some of the leaders that people like. I do cover a lot of these companies that haven't broken out yet, but these guys, I think we're going to see a big move. And again, remember, NXE, that's one of the largest holdings in URNJ. URNJ, which is the Uranium Junior ETF, that's probably showing something very similar to what we're seeing in NXE. Go Uranium. So here's Brennan. Brennan says, millionaires are millionaires mentally before they actually are. Billionaires are billionaires mentally before they actually are. That's why it isn't a lottery winning moment to them. They expect it. Their mental works different than the average person. Remember this. One thing that I will say is he is right. When I was in my 20s and in my 30s, I was like, I'm going to be a millionaire. I am going to be a millionaire. I saved a lot of money in my 20s. I put it in mainly like 401ks and Roth IRAs for tax purposes, and I wanted to reduce my taxable income. What I didn't know is, I didn't know how much money I'd make later on, and I didn't know it would compound the way it has and my dividends and all that stuff. But I was thinking that I was going to be a millionaire, and I had a millionaire mindset in my 20s. And then becoming a millionaire occurred in my 30s. And now it's just how many times over is it going to occur? Am I going to have 10 million in a few years? Is it going to be 20 million? I don't know. Is it going to be 5 million, 2 million? I don't know. But the characteristics I have been with me the entire time. And I don't think I have a billionaire mindset. I've got my mindset is going to fit with tens of millions probably. And that is where he is right. I had that mindset the entire time. I had the savings habits, the mentality. And when I'm hitting these goals, it's not really surreal. It's just like, yeah, kind of know that it was going to occur. Like I always thought it was going to happen. I guess I'm internally optimistic, and I always look at things optimistically. The pessimistic guys, they don't make money. Their mindset is not the correct mindset. You have to be optimistic when you need to be optimistic. You have to be pessimistic when the data and the charts tell you to be. But you can't be pessimistic for 5 or 10 years thinking that things are always going to crash every single year and make money. Your mindset's not right. So mindset is absolutely a important thing to becoming a millionaire or a billionaire or whatever the heck you want to become. Optimistically is a way to think where it's going to occur, it's going to happen, it just takes time. That's what occurred when I was deadlifting, and I wanted to deadlift in 600 and something pounds was kind of my goal. And I've seen people do 700-800 pounds, and those guys are all on juice and other things. So I was like, you know what? Let me try to get in the 600s. I got in the mid 600s, and my mindset is exactly the same mindset as it was in sports. It's the same mindset as it is in making money. It's optimistic. I'm going to get there. I'm going to figure out how to refine my techniques. I'm going to figure out what stimulus I need to stimulate the muscles to grow. You have a whole bunch of exercises that you're going to do to strengthen the joints and do kind of rehab type stuff, which you have to do more of the stronger you get. So it's all about mindset. That's what I'll say. Another one, Game of Trades, and this guy, he posts a lot of stuff that I disagree with, but whatever. This here, I want to talk about the mindset that I take when I look at these things. It says, caution, U.S. office vacancy rate hits 19%. This is higher than even the financial crisis. So he's trying to basically, I think, get people worried. The office vacancy rate is worrisome. This is where I get interested. This is where I'm like, you know what? Maybe there's an opportunity here. Now, I'm not saying that there's an opportunity at this exact time in U.S. office vacancy rates, but when things get to the highest levels, that generally turns me on as an investor. It's like, okay, I need to start paying attention to this. We were at the lowest level in the platinum to gold ratio, platinum to palladium ratio, and platinum to silver ratio. It's not the lowest level, but it's also very low. Guess where I'm investing? Where things are at their lowest levels. This is at the highest levels, which means that there's going to be a lot of distressed sellers. When you get a lot of distressed sellers, that's where your opportunity is. That's where you can negotiate. Your supply demand is favorable where there's a lot of supply and little demand. That's exactly the situation that I want to be in. I want to be able to negotiate with people for opportunities. You want to buy it when no one else is buying. And it's so hard for people to figure that out. And I don't know why it is so hard for people to figure that out. You just do opposite of everyone else. And I know it's hard to not be a sheep. Everyone wants to hide in the herd. I'm telling you, that's not where the money's made. You have to jump out of the herd. You have to buy when things look like crap, when everyone is negative on it. And you have to literally be a person who can think for themselves. And that is rare. People want to be told what to do. They want to be, they find comfort in ideas and opinions that the herd holds because they're not singled out. It says it's official. Central banks keep fleeing toward gold. Watch what they do, not what they say. So central banks have another colossal year of buying gold. Gold is cheap. We've got the patterns that support gold to the upside. And central banks are basically holding the paper price down and accumulating all the physical. What do you think you should do? If they're doing that, and they're eventually going to reprice all their assets at some point, they're not going to be buying bonds anymore because bonds are toast. I'm doing the same thing they're doing. I'm going to be buying physical metals, using that as basically the how can I say it, the stabilization or base of my portfolio. And then I play the ratio game with the precious metals. And that's a good portion of my net worth. And that's what I look at. I mean, that's how I structure the portfolio. Here's another one of Game of Trades. This is a major warning signal. Analysts are repeating the same mistake they made in 2008. Despite a sharp contraction in leading economic indicators, earnings are being revised upwards. This guy has it backwards. It's not a major warning signal. And guess what? It's not 2008. Sorry, I'm getting a little bit frustrated. 2008, we had the housing market peak in 2005. In 05, that's when your housing starts peaked and started heading lower. We had massive surge in inventory levels from 06, 07 into 08. We don't have any of that. These guys are not people that you should follow. Now, what if when we look at this and we start to see this turn and come back up, and this is S&P 500 net earnings revisions. Where's the best time to buy on this chart? Well, it would have been right in 96, in 99, in 2000, in 2009, in 2020, and right now would be a good time to probably buy it if this thing starts to turn back up. He's exactly opposite of what I think is going on. And why do I think that? Because he doesn't know what drives these things. This here was a real estate crash. This was COVID, whatever. This here was the NASDAQ bubble. The NASDAQ bubble reached to this level here. And if you go across, the downside move would be very minimal. And the upside is going to be a lot more. So your risk reward is actually very good to be a buyer in this general area than actually a net seller. And I'm just talking about the mindset that people have. They get all worried when things are low. You got to be opposite. Be opposite of all these people that are sharing this. And I can help you do that. Here's Eric. It says, with the few Canadian large cap exploration production now trading above 6 times EV enterprise value to 24 cash flow at 80, we are increasingly focusing on mid caps who offer lower valuations and much higher free cash flow yields, 20% plus, pretending more meaningful share buybacks in 2024 on a relative basis. Now, this is their free cash flow yield, and this is the names of the companies. One thing that I'll say, on the right-hand side, these are the companies that are high-cost producers. Those are the ones where their free cash flow yield is going to vary the most when the price of the underlying commodity changes. The ones that have the least free cash flow movement will be the ones on the left. I know that sounds backwards, and it isn't backwards. So when you make a lot of money at a low price at 80, if you make a lot, your multiple on what you make in terms of earnings per share growth will be less. If you're on the right-hand side over here, like Crew Energy, CHK, AR, and some of these other ones, when the price of what they sell goes up, they're going to go up at far larger multiples. So if they don't make any money today, if it's basically zero is their free cash flow, on a percentage increase basis, if natural gas doubles, they have an infinite return if you make zero money now, which means that your multiples on your earnings from today are drastically larger than someone who's already making a lot of money today. So that is where the high cost producers provide leverage to the price move of a commodity. You want to be in the high cost producers if you're in a massive commodity bull market. That is exactly what we see in the charts too. When you look at the charts, they're going to be more volatile on a chart when you're a high cost producer. That is where all your leverage is. So right now, what I would be doing is I would be looking at somewhat higher cost producers and looking at companies that aren't making the free cash flow today, but are projected with much higher commodity prices to be flushed with a bunch of cash. So I'm buying the high cost producers. They're not all high cost producers that I'm buying, but I am buying and adding to some of the high cost producers to get the leverage to the price move of the commodity, because I am a massive commodity bull in natural gas and also in oil. Here's Tavi. So he talks about Brazilian stocks remain one of the most undervalued businesses in the world today. What's truly remarkable is how the Brazilian real and its equity market continue to show impressive performance, even in a situation where the Fed is keeping monetary conditions tighter for longer. Look where Brazil is, guys. You're trailing return on equity. So what does that mean? Generally, your stock is a function of the return on equity. As your return on equity is lower, that is generally perceived as lower payouts in the future. So what you want to have is you want to have a low, he's got trailing price to book. You want a low price to earnings or price to book ratio and a very high return on equity. That is going to project some of the highest future returns. So you can see US has good 18% return on equity, but you're paying a lot for their shares. Brazil, you're not paying too much, and they provide a really good return on equity. So Brazil, I think, is probably going to be one of the best locations for future investment. The reason I think that is going to be the case is twofold. One, it's the valuation and the return on equity that he's showing here. Yes, it's of really good value. But two, the market conditions are going to change. And the market conditions have forced everyone into US stocks because of the strong dollar. That strong dollar, and what that means here is you want to be in an asset that has its currency appreciating. So you get a twofold return. You get a one of the fold returns is the appreciation of the currency. The second one is the return on equity that the underlying asset is giving you. So it's a twofold return. It's the return on equity and in the currency that it's returning it in. That's why US stocks have gone up so much, because we've had a very strong interest rate increasing environment, which is favorable for US stocks. Now, when that reverses, generally you'll get a weakness in the US stock market. Interest rates have gone too far. And then the currency will weaken as the interest rate goes back down. When that occurs, Brazil is going to be in favor and emerging markets will be in favor, because what's going to occur is you're going to get a stronger real, and you've got good return on equity, and you've got really good pricing. So what I think is going to occur at some point here, which is basically happening now, I think, is that Brazil and emerging markets are going to outperform other asset classes and other countries. And I've got really good picks, in my opinion, in Brazil that are going to outperform during this bull market that's coming. Seriously good setups. And remember, as Brazil's currency strengthens, their country will strengthen too, which will also do very well for the local companies in Brazil. So here's another one that I talk about, and this is a contrarian view. I know everyone is bearish on home builders. Everyone's bearish on the real estate market. They think we're in a bubble. I do not think we are in a bubble. I think we are going to go higher, and I know that burns people. I get it. Here's home builders. They still look excellent, and with yields dropping, we are still putting in bullish candlesticks, looking ready to go higher. If we continue. Looks like I'm off the page here. 1 second, guys. Let me do this. There we go. We're continuing to put bullish candlesticks here on the right-hand side now that you can see that right there. And I think we're going to go higher. We are going to go higher. Why is that? Why do I think that? Why do you think we're going higher? Because we don't have the homes built. And I know people are trying to argue. Oh yeah, they bring up this data, but guess what? Inventory levels are low, and we are not in a hypersupply phase. Period. There's no argument there. You can try to argue it. Oh, well, the inventory will come. Well, let it come. Then I'll be able to see it, and I'll change my mind. You guys are making fictitious arguments on something that doesn't exist, and that is not how you make money in investing. Right here is telling you that they're going to run these home builders up. Go look at KRE. KRE here's KRE. All right, we'll go KRE real quick. KRE is in an accumulation Livermore cylinder that we just broke the downtrend on. We just broke it 5% up. We are breaking the downtrend line. We're just breaking it. You know how many opportunities there are going on right now? You know what this actually means? It means something. There's a reason this is going to go higher. There's a reason that the regional banks are going to come back around. There's a reason there's a Livermore accumulation cylinder. And guess what it all deals with? The real estate market. It deals with inflation, and inflation is going to come. And then if you look deeper and deeper, you can look at all these charts, overlay it with all the data, and guess what? They all align to what I'm saying. I'm not making this stuff up. I'm not creating narratives. Here's Henrik Zaber. He has a different viewpoint of me, but he could be right. He thinks that we could have a blow-off top in the NASDAQ, and that very well could be the case. You know why I think that could be the case? If we go look at TNX, this is what could potentially occur. We have a declining interest rate environment. We've broken that, and we might get a return move here. And that could cause a blow-off in the NASDAQ. That is completely possible. And again, the data all aligns with each other. You have to know this stuff inside and out, guys, if you want to be really good investors. What's the first thing you're going to do when you become a millionaire? I honestly, guys, nothing occurred when I became a millionaire. I didn't do anything different. I still had my day job when I became a millionaire. There was nothing I did. Not a big deal, in my opinion. Here's another one. 1970s inflation problems was a direct result from the money supply being increased dramatically. You know where that money supply came from? Lending. Lending in residential real estate. Today we have the money supply sitting in the exosphere, and yet the masses think inflation is under control. Below is the comparison of how inflation was measured in the 1970s. It's actually 1980s. Is still well above 10%. If we are a student of economics 101, the cash rate needs to be above the inflation rate to suppress it. And guess what? That isn't the case. They're doctoring the numbers, guys. We have inflation that is still above 10%. And our interest rates are not above 10%. Gonna get interesting. Which would you value more, old friends or your dreams? Now, here's my thing. My dreams are going to be more so than old friends, because if I have friends and they're old friends, that just means that I probably stopped being friends with them for a reason, and that's why they are old friends. If they're current friends or new friends or whatever, current friends, then you're going to have to balance that out, I guess. But if they're old friends, there's a reason that they're probably old. Grady as well, he talks about this. U.S. bonds look to have bottomed, and if so, it means the U.S. yields here should have topped. This also makes sense as yields here has now reached the measured move for the pink inverse head and shoulders. Shoulder, head, shoulder, and there's your projected move. It hit that, and we could have a potential relaxation in yields, and that could drive the overall stock market up with commodities up. Be both. Scott saying, wow, URA very cheap against U.UN, which is the Sprott Physical Uranium Trust. The equities are still incredibly cheap for uranium. Says, what happens to gold when the Fed stops hiking rates? Well, when they stopped hiking rates, gold went up 272%. When they stopped hiking rates here, gold went up 153%. Remember about that yield curve I always talk about, the uninversion of the yield curve. When the Fed stops hiking rates, what's going to happen? Gold explodes. Silver will explode. Platinum will explode. We're going to see some big moves, I think. So I think that's a great area to be looking at, precious metals. So here's another one. Dave Ramsey said, right now is the best time to buy a house in over the next 5 years, says Dave Ramsey. And that was 1 year ago that he said that. It was about 1 year. No, I think it was 1 year ago that he said that. Calvin says, can someone tell me again why everybody is bearish platinum group metals? And guess what, guys? The platinum market is forecast to see a deficit of 1 million ounces this year. The largest deficit on record in terms of both absolute ounces and as a percentage of annual demand. The World Platinum Council said in a press release based on its report. The market saw supply surpluses in 21 and 22. The electricity shortage in South Africa has helped limit mine supply. And those are the companies that everybody's asking to go invest in. So that's what I've got for today, guys. Give me a thumb up on the content. Subscribe to the channel if you guys are interested. Subscribe to the website if you guys want. Discount is the coupon code if you want a discount. So that's what I've got for today, guys. It's all bullish for commodities and the overall markets at this time. And I know people are afraid of a potential recession, but maybe it's behind us. I mean, some of this stuff could be behind us. And usually peak fear generally occurs when something is like we're going through it right now. And maybe when we come out of this thing, we could see some big moves of in our commodity market, and we can maybe even see big moves in the overall market. We'll see. But that's what I've got for today. Hopefully you guys are having a good day. I'm out of here. See ya. Finding value.